What role does supply and demand play in predicting market trends? Imagine walking into a bustling market where the prices of fruits and vegetables keep changing. Sometimes they go up, sometimes they go down. What's behind these shifts? It's all about supply and demand. These two forces are like the engine that drives how markets move over time. They help us understand why prices change and why certain products become popular or less wanted. Demand is about how much people want a product at different prices. If a new phone comes out and everyone wants it, demand is high. But if the price is too high, fewer people might buy it. Supply is about how much of that product producers are willing to make and sell at those prices. If a lot of phones are available but few people want them, prices tend to fall. If only a few phones are available but many want them, prices usually rise. When demand for a product increases but supply stays the same, prices tend to go up. For example, if a new video game console is released and everyone wants one but only a limited number are available, the price will likely increase. On the other hand, if a lot of the same consoles are available but not many people want them, prices will drop. This pattern helps predict what might happen next in the market. Businesses and analysts watch these changes closely. They look at past sales data, customer preferences, and industry trends. If they see demand for a certain product rising quickly but supply isn't catching up, they can expect prices to go higher. This might lead to more companies trying to produce that item to meet the demand. They also consider broader economic factors like inflation, unemployment, and economic growth because these can influence how much people want or can buy. Forecasting demand is a key part of predicting market trends. Companies analyze past sales, seasonal changes, and consumer habits. They might use simple methods like looking at last year's sales or more advanced techniques like computer models that consider many factors. This helps them decide how much to produce, how to price products, and how to manage inventory. For example, a clothing store might analyze sales data from previous years to decide how many jackets to order for winter. A tech startup might survey potential customers to see what features they want in a new gadget. On a larger scale, governments and economists watch economic indicators like gross domestic product growth and employment rates because these influence overall demand and supply. In the end, supply and demand are like the heartbeat of markets. They show us how prices and quantities change over time. By paying attention to these patterns, businesses can make smarter decisions, and economists can better understand how societies and cultures influence what people want and need. This constant dance between supply and demand shapes the everyday choices we make and the products we see around us.